All right, guys, Costco just reported minutes ago. If you're watching this, we're recording it literally a minute after it was reported. They're estimated to get $55.57 billion in revenue. They actually fell quite short of that to $54.24 billion, but they beat earnings. They're estimated to make $3.21 per share. They made $3.30. Now, Costco is a big love of Charlie Munger, Warren Buffett's longtime partner, 99 years old. He said he'll never sell Costco. He doesn't care how overpriced it is. Now, when he says he'll never sell Costco, I kind of laugh and go, sick. You got like 5 months left. What are we worried about here? Like selling Costco in the next 5 months?
My assumption is that he means that he's instructed his family to do the same. But
yeah, so what we're going to do in this video is we're going to go over Costco's earnings release. We're going to go over some important metrics for Costco, things like same-store sales, things like that. And we're going to go over their earnings, then decide using our stock analyzer tool and making our assumptions about the future, what we believe the intrinsic value for the company to be, and what price that means for the stock. Remember, every investment is the present value of all future cash flow. We do these earnings reports a lot, but remember, we don't believe in we don't believe in investing based on missing or beating expectations. They're too short-term focused. The stock right now is down 1.5%. At one point pre-market, it was up almost 2% before they announced earnings. So you're telling me in a matter of minutes, the stock has changed 3% in value, has swung 3% because of missing revenue could very well be, but they beat on earnings. Okay, so they made more money, but they didn't generate as much. Mo, what are you finding in their current press release about the company? What were same-store sales?
Same-store sales, so they put it in here weird. Let me see, can you guys see that? Yes. So they did 4 weeks, and then they did 26 weeks. So they're not forecasting out an entire year.
Yeah, they're doing comparable sales for February and year-to-date periods.
Exactly. But it was positive, which is something we're not seeing from companies. You saw Best Buy this morning. They missed same-store sales were down by 9.9% across the board.
Best Buy?
9.9%. Yeah. So,
total company, 6.8% for the 26 weeks adjusted.
Yep.
And overall, 5.6%. Look at e-commerce. Big drops in e-commerce, same-store
big drops.
E-commerce sales. That's impressive.
Let's see if there's anything else here.
For the 26-week period ended February 26, 2023, net sales were $116.06 billion, an increase of 7.1% from $108.39 billion last year.
And there's something else I wanted to point out here. So where was the revenue side? Net sales for the quarter increased 6.5% to 54.24. So even though they missed expectations, it was up from basically $51 billion at the same point last year. So sales are better this year than last year. Could go to inflation. Could go to. People are still spending.
Well, I'm sure inflation is. Yeah, I'm sure inflation is driving that, guys. Exactly. At the end of the day, what are the margins on Costco? So let's go right here. Gross margins are 12%. That means every time they sell a product at the store, they got about 12 cents, 12% of every dollar or 12 cents in going to pay for their overhead and their income taxes. And look at their bottom line profit. Very consistent, Mo. Look at this.
Very extremely consistent.
2.5%.
Yep.
5-year average is 2.5%. Last 12 months, 2.5%. So there's not a lot of margin there. And you've got to think that as these costs go higher, they're going to pass it right through the customer.
Yep.
I heard Costco is finally starting to increase their membership rate. They're talking about that.
So they do that once every 5 years on average from what I see.
But that hot dog is still staying at $1.50.
Hot dog, I think it's hot dog and a Coke.
So they said they're never going to increase that. So you're telling me 100 years from now.
That's what he said.
You're telling me 100 years from now, that hot dog is going to cost them $20 each. And they're like, yeah, we're going to keep it at $1.50.
I don't know.
That's a ridiculous statement to make.
You know what I think the most genius thing Costco does?
What's that?
So you buy a pack of 40 bottles of water for $3, call it. They have that vending machine of waters, 25 cents each bottle.
Oh, wow, really?
That's genius. Because you look at it and you go, it's a quarter, it's nothing. Imagine that's a lot if you buy, what's 40 times 25 cents?
$10.
There you go. That's incredible.
You didn't do that in your head?
No, I have you.
Okay, so.
Why would I do that in my head?
Mo, can you do me a favor? Can you pull up the 10K and show me the number of stores they have open and they're opening? Now, this won't be for.
Let's see, they put some numbers here about stores, but you go ahead. Oh, here you go. Currently operates 848 warehouses, 584 in the United States and Puerto Rico, 107 in Canada, 40 in Mexico, 31 in Japan, 29 in the UK.
There's a Costco in Manzanillo.
That's actual Costco?
Wait, or is it Sam's Club? It's definitely a Sam's Club.
Yeah.
Yeah, we don't have a Costco Manzanita.
Yeah, no, I didn't think so. Sam's Club. So there's your store numbers.
Okay, what are they opening? What are they closing? Anything like that?
Let me go in 10K.
Now, this information that Mo's pulling up will be from last year's 10K, not from this year. So that's something to keep in mind. But let's start looking at some things of the company that I find interesting. Couple things. 18.2% 5-year return on invested capital. Last year, 18.4%. Very consistent. What does this mean? They get a good return on the money that's invested in the business. So based on this, if they want to increase their profit by, let's round this up to 20% to make it even. If they want to increase their profit by $100 million a year, they have to invest, divided by 20%, $500 million. Now, you might sit there and say, big deal. Well, it is a big deal because 20% versus 10%, you have to invest half the money at 20% to get the same growth. That means Costco gets a pretty good return. And Warren Buffett and Charlie Munger both say that even if you overpay a little bit for a company, basically the return they get on their capital is about the return you're going to get on the company, on your investment. Why? Because as you reinvest your capital at those high rates of return, you're going to grow the profit at that kind of rate. And as you grow the profit at that level, what do we determine the price of the company to be? Based on a multiple of profit. So if the profit's growing at 18% and the multiple is always 15 times earnings, eventually the company's price on the shares will grow 18%. Now, the question is, and Munger has been very specific about saying, even if you overpay, I alter it with by a little bit. Because if that's the case, just go find the highest ROIC and just buy it, right? Great, Apple's got a 40% ROIC. Just go buy it at whatever price. It doesn't matter if it's $500 a share or $100 a share. Buy it at whatever price. Obviously, you can't do that. So let's look at they pay a dividend. Look at that. Dividend's about $2 billion, which is about 40% of their free cash flow.
They're notorious for that special dividend every once in a while.
Here's their 8 pillars. Now, this is my own 8 pillars. You can customize your own 8 pillars here for our users of our software. The stock's still down about 1.9%. This is a very high price to free cash flow and PE ratio. Mid to high 40s. That's a lot. I would argue that if you bought Costco at these prices, you're probably not going to get an 18% return as the return on invested capital says. Because this is a very mature company. And you should pay more for a company with a high ROIC and a lot of growth potential. The question is how much growth potential they have.
Yeah. So in 2022, they opened 26 new stores. 3 of those were relocations, 14 net new in the U.S., 2 net new in the Canada area, 7 new in other areas, compared to 22 new warehouses in 2021.
Okay.
So I remember when the Costco CEO years ago, he said, our goal is to be within 20 miles of every house in America.
Is that what he said?
Yeah, he said that, that was 2016, 2015, something like that. I don't know if that's still their goal or if that was just some kind of talking point, but I was like, it's an aggressive statement. Within 20 miles of every house in America.
That is pretty aggressive. All right, so let's look at a couple other things. Analyst estimates. Mo, you want to run people through some analyst estimates here? Because I think this will, exemplify what I'm talking about.
Whoa.
Yeah, I know.
On the earnings per share side, they're going from $14.82 to $23. Wow. That's, low teen growth. Granted, it does drop to 6 analysts by 2027, but on the revenue side, $249 billion to $324 billion. Mid-single digits. What do you think about that? Mid-single digit growth on the revenue side?
No, I understand. The thing that's interesting is this proves the whole return on invested capital.
Yes.
So look,
it's so great over here compared to down here.
So they're growing revenue a little bit, but that extra revenue comes in so they can return a higher number on there.
Yep.
It returns a bigger number to the bottom line. That's exactly what ROIC does. They get more money in, they reinvest some of it, and it gets much higher growth rates. And I like the fact that there are 22 stores is not a ton of stores.
No, it's really not.
When you have 800 and some locations, you're only growing 22, that's what, 2.5%?
Yeah, it's really not much.
That's not a lot. So I like that.
Yeah.
And look at their overall revenue growth over the last 10 years. We have it, our stock, they're down 2.2% now. Still 9% growth rate over the last 10 years. Now, Mo, do you want to do a little task for me real quick?
Sure.
How many stores did they have back in 2012?
Okay. Let's go
So what we're going to do here is they have a 9% revenue growth rate here. Now, I want to see how much did their stores grow per year. Because let's say their stores, let's just go to extreme. Their stores they have 100% more stores than they had before. They have 850 now, they had 425 back then. Well, I would sit there and say, okay, 9% a year for 10 years is, so what we do is we sit there and go 1.09 to the 10th power is 2.36. That would be bad then, because they grew their stores by 137%, but their revenue by 137%, but they doubled their stores to get there. So they really only had 37% of natural growth over a 10-year period.
So as of December of 2012, they had 622 warehouses.
Okay, so they have what, 848 now?
848, is that the number I said?
So roughly, they've grown their stores by 3% per year. So I like the fact that I look at this saying they grew about 3% a year in stores, but their revenue growth was 9% per year. All right?
Nice.
So what we're going to do here, guys, is we're now going to use this whole entire system and our most important aspect of our software. This is used 1.3 million times by our users last year. Now, guys, if you like the software, we have a special running because it's earnings season. $7 to try it out for 7 days. It's $1 per day. Try it out. If you like it, you'll stay on at the rate, and the rate is going up soon. So whatever you lock it in now, you get that rate, and you're stuck in that rate category forever. That category will go up, but you'll still be the cheapest. You'll still be cheaper than the highest rate. $1 per day, no brainer. You get this, you get the community, you get all of our data going back, and you get every addition of the software that we're doing over time, because we have not even touched the surface, scratched the surface on what's out there, what we're going to put out of the software. So Mo, you do a 20-year analysis. You do a 10-year analysis. I'll do 20-year.
Okay.
So, okay. So here's where we make our assumptions. The first assumption is going to be revenue growth, then profit margin, then free cash flow margin. Then we assign a PE and a price to free cash flow at the end. And then finally, we do our desired return. Your desired return is basically what's intrinsic value, like 10% you can get from any sort of long-term ETF. So what kind of return do you want to get? My recommendation is for margin of safety and for a reason to buy an individual stock, you should have a higher return. So Mo, what'd you do for revenue growth?
I did 4, 6, and 8.
I think it's wonderful.
I almost went 5, 7, 9, but I think 4, 6, 8 is a good number.
I did 3, 6, 9. Profit margin?
2.5 across the board.
Same with me.
2.5.
That's what I did. It's funny. I was thinking to myself, like, oh, Mo's going to laugh at me for doing this. I was like, you know what? It's just so consistent.
Yeah.
Just effing leave it.
It is. Same for free cash flow margin, 2.5% across the board.
Same with me. PE?
I did 16, 17, and 18.
Okay, I did 15, 16 and a half, and 18, but I don't blame you for that.
Okay. Same thing for price to free cash flow. And my return, 10, 12, and 14%.
So we were pretty spot on in these things. The only difference we had was revenue growth. And I think Mo's at a higher revenue growth number than me makes sense on the lower side. Yep. So we're going to hit the Analyze button. The stock is currently down 2.2% at 475. Now remember, wherever these prices end up, it doesn't mean you go out and buy if it's all green. It doesn't mean you necessarily avoid. The whole point is it's a starting point to go look at this. And remember, this does not include the balance sheet. So this only tells you if the balance sheet is fine, this is what you pay. Yep. Scroll down. Mo, what you got?
215 to 230, middle ground 225, and it's on my watch list at 225.
I have 190, 260, 225 on my watch list at 200, but I'm probably going to change that now to 250 to be honest, because I'll start selling puts at lower prices. So guys, thanks very much. Again, $7, 7 days. Check it out at everythingmoney.com.